I mean, investing it's a little less rigorous because there is no objective truth, but in the end you have like a scorecard, and that's the share price over time. And I think it's way more creative than people may. I mean, I think investing is a very creative pursuit. There is no right or wrong way to come to the value as long as it's the right way in the end. So I basically use just my way of thinking of basically building up a investment thesis like you would build up a proof to have some rigor, and looking at it from different directions. So I think that is a very helpful, just experience or skill set to have. But also there's maybe more on the data part. I mean, knowing like statistics and the shortcomings of the statistics and how to use data, I think helps. I think a lot about, probabilistic thinking. To me, an intrinsic value is not a number, it's a range, because there is no certainty around it. So it's more like a range. And the optionality, you can buy something at the lower range or even at the higher range. Like it depends on how big the range is and the distribution. So, having like some kind of understanding how to think about these concepts, I think helps you a lot. Having some kind of process and way to compare ideas, not getting like falling into like a trap or like let's say like being victim to your own biases. Is this like as objective as it can be, or get them carried away?
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. You know how researching a company can take forever, digging through filings, transcripts, and reports trying to make sense of it all? That's where Tenzing Memo comes in. It's an AI-powered market intelligence platform that helps you research public companies in minutes instead of days. Created by stock analysts for stock analysts, people who love the treasure hunt of investing. I spent over 20 years investing professionally, and when I started using Memo, it immediately became part of my process. It surfaced new ideas, helped me spot insights on stocks I held for years, and connected data points I'd completely missed. It's fast, intuitive, and gives you a research superpower. Tenzing sponsored this episode to help us make Talking Billions better for you. Use code BILLIONS at sign up for an extended trial and 10% off. Check out Tenzing Memo today. My guest today is David Diranko, a German data scientist turned professional value investor who uniquely combines machine learning insights with contrarian investing principles to uncover overlooked small-cap opportunities in fragmented European markets, all while building his investment advisory firm, Duranko Capital, and sharing his research through his popular Substack newsletter, Contrarian Cash Flows. David, how are you? So nice to see you again.
Thank you, Bogumil, for having me. I'm doing well, and I mean, you're one of the most thoughtful interviews in the investment podcast space, so I'm really looking forward to this one.
So I'll mention for the benefit of the audience, you were on the show. So if you guys are listening, look up the previous episode with David. You'll have a head start listening to us today. We met through Guy Spear, ValueX, and Guy is a wonderful person and introduced me to a lot of people. And you gave a lot of incredible presentations at ValueX that caught the attention of the audience. So every time I talk to you, I'm always inspired. And I have so many questions for you. I want to get through a lot today. So let's jump right in. I'm curious about your journey. I know we talked about it, but it's a bit unconventional. Data scientist at IBM, launching your investment practice, becoming a full-time professional investor. Tell me how that came about.
I mean, as I think we just previously talked about my background, but I'm a mathematician, and I started out working in the investment space. So I worked for a German asset manager, the asset manager of Munich Re, the insurance company, during my bachelor's degree when I did business mathematics. But that was all the exposure that I had to the investment space at the time, and the institutional investment world, especially at an insurance company, was not necessarily what I imagined it to be or what I imagined my career to be. So I just thought about at that time I think I was 20 at the time. I mean, what can you do with math instead of working for an insurance company? And I mean, back then, machine learning was still a thing. I mean, now it's in everybody's head and mouth. But I mean, it happens that AI is basically math at scale. So I thought pivoting to mathematics and data science and joining that space would be, I mean, a very promising career and very interesting. And it doesn't hurt to learn how to code. Yeah, so that's why the pivot came about. And I worked for IBM. And I mean, it was a great job, but the investment bug caught me back then. I mean, I then learned about Warren Buffett, as many of us do. And I mean, that part of investing and investing based on intrinsic business value, like, resonated much more with me. So I kept pursuing it with my own money and my family's money, and now even outside money. Yeah, and I mean, eventually, around 3 years ago, I basically worked 2 jobs. So I worked my IBM 40 hours a week job, and I did investing on the side. But I mean, if you want to be good at something, and I'm definitely a competitive person, I mean, I spent probably another 30, maybe more hours per week. So I mean, it takes a lot of toll on your time. And I mean, around then we also had our first kid, got married, and I mean, at some point you have to prioritize your life and even your professional life. And I mean, for many, maybe the step was crazy, but I had a well-paying job, and I even liked the job. There was nothing wrong with it. But I mean, if you do 30 hours of work on top of your job, maybe that's what you should pursue. And I mean, I'm an entrepreneurial person, and my wife as well. So we had already interest from people that, I mean, asked. I was doing well with our own money, and asked if I could do something for them. And that's basically when we made the decision. So we still have a couple of years of savings, and basically said, I mean, why not launch this and try this out? And now we're 1 year in, and so far it's been absolutely the right decision. Yeah, so that's how the journey has come about, and I think it's my way.
I find it fascinating how many people find their way to investing from so many different directions. I met lawyers, accountants, data scientists, engineers, software engineers that decide to become investors. And I think it's one of those bugs that I think it's not curable. I met 90-year-olds that are still opening annual reports and trying to figure out a new business. And I find it fascinating. I think it's always fresh. It's always new, because businesses come and go and new ones appear. As I'm listening to you, I'm thinking that Buffett's mentor, Ben Graham, might have been the original data scientist. People don't talk about it. Maybe we forgot, but he would take what was available at the time and go through numbers and try to find businesses that he thought are so cheap. As a backdrop, he was doing it during the Great Depression, which was a time when people lost faith in the stock market. No doubt, when the market went down, I think 92% from the top to bottom, 1920 and 1929 until 1932. Really, really rough period. I can't even imagine what it was like. So he was trying to pick up stocks that he could basically liquidate and get more cash. And he was using data to do that. You discovered Buffett. And then what I see is you married the two sides of, your interests, investing and data. How is that helping you identify ideas, the data mindset?
I mean, maybe first of all, I don't use that much of AI. Maybe for many people it's a surprise, but I use a fair bit of my math and statistics capabilities. So I think like the way to approach math, I mean, at a university level is, not that dissimilar on how to come up or analyze a business, because what math is all about is actually not calculating, but it's actually proving. Like you get a problem, and then you have to find a solution. Actually, you have to prove it. So there is some rigor to that, and there is like a set of rules that you can use, and you can build on what you have already figured out. And that's all you have. So it's actually a very creative pursuit to some degree. And I think, investing it's a little less rigorous because there is no objective truth. But in the end, you have like a scorecard, and that's the share price over time. And I think it's way more creative than people may. I think investing is a very creative pursuit. There is no right or wrong way to come to the value. As long as it's the right way. It's the right way in the end. So I basically use just my way of thinking of basically building up a investment thesis like you would build up a proof to have some rigor, and looking at it from different directions. So I think that is a very helpful just experience or skill set to have. But also there's maybe more on the data part. Knowing like statistics and the shortcomings of statistics and how to use data, I think helps. I think a lot about, probabilistic thinking. To me, an intrinsic value is not a number, it's a range. Because there is no certainty around it, so it's more like a range. And the optionality, you can buy something at the lower range or even at the higher range. Like it depends on how big the range is and the distribution. So having like some kind of understanding how to think about these concepts, I think helps you a lot. And also we talk about later, and from idea generation to analysis, like having some kind of process and way to compare ideas, it helps as well. And also like not getting like falling into like a trap or like let's say like being victim to your own biases, like as all of us are, and I'm not an exception, but is at least being aware of it and like being able to check in at times to say like what am I feeling, what am I doing, like that is this like as objective as it can be, or get I'm carried away.
I have so many thoughts. I like the idea of intrinsic value being a range. I'm sure we'll come back to it. When I'm listening to you, I think that numbers maybe allow me to keep me kind of in check. I'm not a venture capital investor because anytime somebody showed me a new idea that's not even out there in the world, it always sounds so exciting. There are no numbers, no reality, but the story and the storyteller, a passionate young founder, unstoppable force. And I would never know when to say this is not going to work out. That's why I focus on the public market, because I want to see a bit of a proof that this has worked. People actually want to use it. People want to pay for it. There's a profit. So numbers are kind of a check on this unlimited excitement that you can get yourself into if you're hearing somebody tell you an incredible story. We'll come back to AI. I have a warmer feeling around it. I'll tell you why. But tell me about Contrarian Cash Flows. You decided to share your work, learn in public, and you build a community. People follow your work. What have you learned from it? Like some people never really speak up, never share. You chose to do the opposite and share. What have you learned from it?
just from, I mean, starting with maybe my personal investment process, it's just very, very helpful to actually write down your thoughts, because then you actually figure out like how well you understand it. Because the brain tends to skip steps that are unclear. And so you build like a narrative around it and you don't even recognize it. But if you have to put it down on paper, like, and you read it, like I mean, even during writing, you quickly figure out if there is like a gap, and then you can do more work on it. So that's tremendously helpful. And secondly, I mean, I've specialized a lot in small names, and there is a lot of like volatility in the prices. It's sometimes also in the business. So like having an anchor, like what you thought about it, or what your analysis was maybe a year ago or even 6 months ago, helps you in the heat of the moment just to check in and say, like, have the most important things changed? And that updating it over time, like, also holds you accountable to your analysis. I think first, like, that is independent of like putting it out. I think that's very helpful to every investor. I mean, putting it out it started for me as simple as like building a community, because I was like a self-taught, like I did it on my own. I didn't have like any network in the space. So putting my thoughts out first, I mean, helped me to get some feedback in the first place that I never had. And I mean, over time, building a community with the following. And finally now with the business, it's also some kind of distribution, or even like, distribution platform, or even like marketing platform, you could call it, for people to find out what I do. And then they either do it themselves by reading the newsletter, or even they think they hand it over because the way I do it, or we do it, resonates with them. And I think it's a great experience. I mean, I met interesting people like that are subscribers. I met them in person. Some of them invested. So it's a great way, I think, to learn, and it's a great experience. So I would encourage everybody to. I mean, maybe it's not for everybody, but if you like to write, I think it's a good way, to build an audience.
It's both a very vulnerable place because you're sharing your thoughts out there with the world, like I do sometimes. But at the same time, it's very empowering because you get a lot out of it, just hearing what people think. You know, when I give talks now and then, I tell people, what you hear, what you're about to hear, it's just an opinion of one person, my experience. And feel free to poke holes in everything you hear, because that's how I learn. You know, tell me where I'm wrong. And we all have blind spots and we all have biases. So if somebody can point out what I'm missing, this could save me money, and this could maybe open my eyes to an opportunity I can't see on my own. You pointed something out, a couple of things, but one is the more conversations I have here and off the record, I have this realization that there are probably 1,000 ways to make money in the market, across sizes and preferences and even time horizons. There's no one size fit all. You have to find one that works for you. But you found one that's in the small cap among European companies. It's a fragmented market. They're not all alike. They might be overlooked. Can you tell me why you find them more interesting? I kind of set it up already, but why do you find them more interesting than the ones that everybody would recognize and their household names and they're large? What do you find appealing?
I mean, first of all, Europe is a focus point, but we do basically small cap companies across developed markets. So we also look to Canada, to the US or Australia, for example. What I think is interesting about it is, two things basically. I'm still basically an owner operator, so I do all of my work by myself. So I think it's just a very, very difficult task to get a variant perception that is like different but right in a very well-known, well-researched company. And most of the big companies are complex companies, and the way the intrinsic value develops over time is like very, very faceted. So I don't think that I can get a better insight there. And to be honest, if I had the opinion that there is like a lot of opportunity out there, you could buy the S&P 500 or like an MSCI index. So why pay a manager or even like spend time on it if you think that is a good hunting ground? So for me, it was like some of it was by design, but also like accidental. That it just appears that there are. I mean, if there are more stocks, there are just more small stocks than big stocks. I mean, as a market cap, not, but like the number of companies is bigger. So just by that fact, the number of mispricings or the chance of a mispricing is bigger. And what is very interesting is that a small company tends to have usually like a single line of product or like maybe two. So you have like you can get isolated exposures, and therefore like you get very interesting, if you want to say positively, or weird price movements, because if something happens with the business, and it's usually very isolated. So I think if you want to build like an actively managed portfolio, and now I think about clients, like what you cannot put in an index fund, or where I think it's not that good to index. So if you want to build a product, I think it's just a very interesting way to put up a portfolio that just behaves very differently. Ideally, if you do your job right, behaves better, but time will tell. So I think it's just I think it's very interesting. It's just a interesting way to solve the puzzle. But also from my personal, like if you want to think about positioning, coming from Europe, if you think about all the reasons why venture capital has worked so well in the US, why the big platform companies like tech, but even like consumer brands have worked so well in the US, if you put it on its head, that's I think the reason why small stock investing works better in Europe. So if you think about the US is like a vast but very homogeneous market. You have like rule of law, or like the regulatory system is more or less the same across the entire country. The consumers very much the same, and the financial markets are usually very deep. And I mean, if you're in a crisis, not but beyond the crisis, like wide open, so you have access to capital. And that's just, I mean, an insane advantage for like big platform companies at scale. In Europe, you have like a lot of different countries with a lot of different cultures, languages. I mean, rule of law, or like most of them are like capitalist, but the way they live capitalism is very different. Different regulation is very different. And I mean, to be honest, the capital markets are neither that deep nor that open. So, I mean, I can tell you as a small entrepreneur, raising money in Europe is very hard. People are very, very risk averse, and there is not a big culture of stock ownership. And that's also the reason why, I mean, venture capital or even private equity is not that. I mean, it is present, but it's not comparable to the US. So if you look at that setup, that's why I think it is objectively also true that going public in Europe as a small company is still a very valid way to raise money, because being public in Europe it costs, I think, 100,000 euros, or maybe a little bit more to be public. So it's not like the millions that it costs in the US. So it's not a big toll on a small company. And I think for that reason, if you look at the data, small cap value investing has worked well in Europe over time. I mean, maybe not as good as the S&P 500, but I think you had very acceptable returns. And I mean, one concept that works in one country can work in another with a different company. So I think that degree of fragmentation, maybe not that access to capital, is I think a very, very good hunting ground for a stock picker.
So many thoughts, but you pointed out something that it has worked. And I like that concept, because I think we get so obsessed these days about an index, and everybody's thinking about the S&P 500. And a couple of people, one way or the other, expressed this thought to me, how, this style doesn't work, or this was a rough time for this style. And I said, well, tell me about the returns in that style or that niche. And say 10% or 11%, whatever the number is. I said, well, if you take away the S&P 500 and you find a way to compound your money at 10% over a decade, whatever that style is. I mean, of course, there are no guarantees. The market can surprise you, but out of context, here, 10%. Wow, that's really good.
No, it is. Right? It is. And I mean, I tell my clients all the time, I mean, if we do the 10% for a very long period of time, I think I would be happy, and most of my clients would be happy. But I mean, to be honest, like in Europe, people are not used. I mean, no European puts all his money in the S&P 500, nor does he put it in his own like home index. And beyond the S&P, like the indices in Europe haven't performed that well. So I think expectations in the stock market are a little bit lower, which helps as a manager. But no, I agree. I think that's a very good return. But even, I mean, saying that like value investing hasn't worked, it's I mean, kind of a lazy argument.
Yes.
Because, I mean, what is value investing? When you say like the traditional, but even like if you take the really traditional way of like buying low price to earnings or price to book, I mean, that, by the way, still works in small companies. If you have to really dig, but there are like very weird situations with very small companies where you can buy stuff for like there are nets out there. That's not what I do primarily, but like it does work. Maybe not if you basically take the biggest 1,000 companies in the US and that's your hunting route. I mean, probably not. But I think it's more like where you look and also like how you interpret it. And so, I mean, I think it will always work buying stocks for less than what they're worth. I think it will always work.
Less than they're worth. When I look at it this way, when people try to label me, I say I'm a value buyer, growth holder. If you really want to corner me, then we can talk more about it. But I ask people, if you bought a stock, why did you buy it? And if somebody tells me they bought it because they think it's worth more than they paid, you are a value investor. And it's kind of secondary if you bought a small company, a large company, a low multiple or a high multiple. At the end of the day, you looked at it and you thought, it should be worth this much. I paid this much less and I got a deal, right? And to me, you are a value investor. And value investing is not something we invented 100 years ago. I think value as such is in our DNA and goes way back. And it applies to you shopping for groceries. It applies to prehistoric people looking for, dinner and trying to spend their time the best way they can to get the biggest calorie output from their investment. Value as such, we walk around and we're always thinking about value, how I spend my time, how I spend my money. And it's been with us, and we are here because a lot of people that were here before us made some really wise choices about value, right? So we are applying it to this very limited universe of stocks, but value as such, if you pull somebody from from the street, they know exactly what value means. They do. We go into investing and we start buying stocks because they went up. Well, if you bought a stock because it went up, or because your friend bought it, or because you heard an incredible story, you're not exactly a value investor. I don't know what you're doing, but it's something else. But I'll leave it at that. So when people say value investing is dead, I don't think it's a fair assessment. But anyways, separate topic. You're looking for companies with temporary problems. And I really like that because it's something that I look at too. But why do you find that attractive?
I mean, first of all, you basically said it like we want to buy stocks for less than they're worth. So, there must be a reason why somebody sells them to us. And, it tends to, I think, mostly for businesses that are predictable and that have done well recently. There is not a very good reason why they should be cheap. So, you have to make a really good argument why. So there must be some kind of temporary problem. It can be with the company, it can be around the company. That really doesn't matter. So that's, I think, where the mispricing comes from. And I think my interpretation of value investing is maybe more a little bit traditional than maybe some of my colleagues in the US. But yeah, it's, what is a temporary problem? This can be like a company losing some kind of, maybe losing a customer, or like is it being stuck at a very difficult point in the cycle? Maybe competition has come in. So like these are all problems, like macro headwinds, COVID was or like inflation. Yeah. Like there are many different problems at different stages. So what I'm usually drawn to is like I would say a sell. Most of the time it's a sell-off. So it's the stock just went down a lot, and yeah, where do you want to take, like, where should we drill down from here?
No, I like that because I see this as something of quality with something that's happening that's not a permanent damage. And I think I always ask myself, is this a permanent damage? I'll tell you a quick story. I had a teacher in elementary school, And there was a test that I wasn't up for it. I don't know if I was sick or not well, but I didn't do well on that test. And I was devastated. But the teacher took me aside and he told me something that stayed with me. He said, I know what kind of a brand you are. Like, I know what kind of level of preparation you usually put in. And I know that this wasn't you. And don't worry about it. There will be another test. And it really stayed with me because I saw that he saw me for the kind of student that I believed I was, which was I hope I was a good student. The same way some businesses hope they're good businesses. But we all have that day when we're just not up to speed, a little sniffles, a headache, and you just miss it and you're going to get, a third of it wrong. And a teacher like that really gets it. And we're investors like that look at the business. And the market is so short-sighted, again and again. A missed earnings release or a lowered guidance or a delayed product release or a product they have to pull from the shelves, it happens. But under all of it, you say, this is a really good student. They just had not their best day. And you're able in the public market to go in and buy something half off again and again. Huge difference in my mind between the private and the public market. If you have a family-owned private business that has a hiccup, hardly anyone knows about it. They just open the doors the next day. They move on. They're not running around trying to sell the business. Public market, a very different story. People panic together. The stock is half off. And here you are, David, looking at the stock and thinking, I could wait a year or two and I can see them come back and show again how they can do. I want to ask you about free cash flow as the core metric that you look at. People look at different kinds of things. These days, a lot of people look at the top line growth, the earnings per share. I'm under the impression that very few people look at the balance sheet and not too many people look at the cash flow statement, which is a true reality of the business. Why free cash flow matters to you?
I think in the end, most investors would agree that a business is worth the cash that it generates for its owners over time at the appropriate discount rate, whatever that is for you. So in the end, you have to come to that metric. You have to tie to that metric. I think the way to get there is different for everybody. And I definitely have a more flexible approach to it. Not that I like to pay for companies that don't have any free cash flow. But let's say from an interpretation of value, I think there is what I consider, and I think that's basically the capital cycle theory. There is like a duality between asset value and let's say earnings power or cash generation. Because if you say like it's a perfectly competitive space and you don't have a competitive advantage, over time you should earn like the cost of capital on the assets that you put up or that you put in. And if you earn too much, somebody else will try to compete and bring the price down. So there is some kind of duality. And I think that's where the cash flow, the earnings power is tied to the balance sheet. And I think there must be like a connect. And I think that's why I think many people don't get the, let's say like low price to book, for example, doesn't work. If you actually appraise the asset value correctly, then it still works, because I like to think about replacement value of assets. And that concept works, I think, really, really well for all kinds of businesses, even like for brands. I mean, for example, it's straightforward. If you have like industrial business, I think book value tends to track replacement value very well. So if you now think, but let's get more creative. Let's say you're like a consumer brand. I mean, pick your favorite brand, and I mean, maybe it generates like 30% return on invested capital. So now you may I mean, the question is that sustainable? And I mean, I think that's always it. Maybe it gets, I think Lululemon is maybe, I think that one is also like under pressure. And now you sit there and ask yourself, I mean, is that a value trap? And I think if you think about replacement value of a brand, maybe you come to a conclusion, because it's about competition. And I mean, you think about what is the asset value of a brand? The asset value of a brand is usually some kind of mind share. And you generate that usually through some kind of marketing spend. I mean, maybe it's not like television anymore, like television marketing, but it's like brand ambassadors are huge. So you have like your influencers or whatever. So you spend all that. And I mean, you have to think about how long was the shelf life of that incremental spend, how many years. And if you think about like in that terms and actually would capitalize all these expenses, like, I mean, don't have to be perfect. You get some kind of replacement value of the brand that is probably materially higher.
Mm-hmm.
And then you have to think, is there something that you can measure? But I'm very conservative. I say like if especially in the small space, I think you have to name that. I think there is no real durable competitive advantage in a small business, because if somebody spends enough money, they can compete with almost, like Amazon can probably replace 99% of small businesses if it wanted. And the only reason it doesn't want it is because it's not worth it. And so
Too small.
Yeah.
Too small.
So if it's like if it trades below its replacement value of its assets, and that's the two questions you have to ask if you say it's a value trap, or not, is like, does it trade below its or materially below its replacement value? And is the product or service still desirable a couple years out? Because if it's not desirable, like nobody will pay for it anyways. And if it's materially below replacement value, there shouldn't be competition, or like the existing competition should go out because they don't earn an appropriate return. And I think that's that is at least my way to distinguish between what some people call a value trap or maybe just hidden value. And it, as I said, it works for hard assets, it's usually easier to calculate or easy to figure out, but it also works for all kinds of intangible, like software companies, for brands, as I mentioned, which requires a little more creativity, but it works well. And I think it's worth for everybody doing the exercise, because even if you say like Apple, for example, like actually calculating what kind of asset would get Apple's current return as like its cost of capital, and like figuring a way out to say like how have they built it? I think it's a valid exercise to do for every of your investments, just to figure out where the value actually comes from and how you could actually calculate.
I'll mention for the benefit of the audience any stocks we might bring up here. No recommendation. Do your own research. You might be listening to this and figure out on your own if they're worth your time. But it's fascinating what you're explaining, because I see a business as almost a miracle, because it's a certain setup of circumstances that allows somebody to provide a service or a good to a larger audience, to customers, charge enough to make a profit, and do it in a world where everybody's watching what you're doing, and they want to do exactly what you did. You're baking a round bread. I want to bake a round bread. You want to bake a square bread. I want to make one too. And actually the success of any business attracts even more attention, because everybody sees, look, the round breads are really selling out. You can barely buy one. So I want one too. I'm going to make one. I'm going to start a bakery that makes exactly the same bread. And there are a lot of things that you can't build a moat around. So it's tricky, but around a brand, around a customer, loyalty, you can build something, and it takes years and decades, and it's a share of mind, and that's very hard to evaluate, but it's there, and it's a question of how much are you willing to pay. The one thing I want to point out, I think the challenge with investing is that when you look at financial statements, which are the numbers that we talk about here, they show you the past, but the value we're trying to capture will be created in the future, right? Even the returns that you talk about, I'm always intrigued about the incremental money that's going back into the business, right? Are you getting the same returns you historically got? And that's a very serious challenge for a lot of businesses, because the best business might have been already behind them. Whatever they're adding is not as good. Too many people focus on just the top line and they see the additional billion. But does it compare with the billion that you guys earned before on a different capital base that you guys had? Anyways, food for thought, and I find it fascinating to go deeper and understand how that works. You have your ideas, you're building a portfolio. I understand that you're in favor of a concentrated portfolio of high conviction ideas. And I want to bring it up because I think there's this untold truth in investing. People look at the index and they say, I'll beat the index. And what they're trying to do is have something that's very similar to the index, just slightly different. And Robert Hackstrom, who wrote The Warren Buffett Way, pointed out to me something that really stayed with me. He said that the truth is that you have to have a low turnover concentrated portfolio with quite a bit of volatility and drawdowns to truly have a chance at outperforming the market, if that's your goal even, because I don't think it's a goal for all investors. But if it's your goal, do it in a concentrated way. Tell me your thoughts. Concentrated portfolio, high conviction ideas. How do you think about it? How do you hold those positions? How do you think about the sizes at purchase? How much do you let them run? However you think about it.
I mean, first, I think it's much more an art than a science, and I don't think I have figured it out yet. I mean, my way to building a portfolio is much more bottom up than top down. So it's, I mean, how many stocks can I do good work on, and can I follow, and can I have a differentiated opinion? And I mean, if I would be able to have like 100 of those, I probably would own 100, but I think it's just not the way it works. So, I mean, for me, the sweet spot is something, say, in a number 12, 15 stocks. So, I mean, when it more, I think there are not that many good ideas that I can actually thoroughly analyze and understand. I mean, lower, it's probably like from maybe it's more like having the guts. But I to be perfectly honest, I don't think that Charlie Munger did the investment world a favor saying like all you need is 3 stocks. I think it's I think it's for 99.9%, even of active managers, that's the wrong approach. And so I think it's like the sleep well factor plays in, and it's also if you have 3 stocks and you have a blind spot, like it can ruin you. And for me, that's, if we tie it now to position sizing, I build positions at cost that are big enough to matter, because if it doesn't matter, like what I'm doing, what am I doing? I'm an active manager, so if I place a bet, it has to matter, because that's what I do myself, but that's also what someone else pays me. And it should be like small enough to not sink the ship if it goes wrong. And for me personally, it's like between 5 and 10% at cost. That's how I define it at the moment. That may vary over time. I don't think I will do less than 5%, because it doesn't really matter, I think. But maybe if I get more comfortable over time, like I would increase it at the top, but that naturally brings you to 10, 15 names. But that is I want to make it clear, it's at cost. So, I mean, if a stock goes up a lot and the business improves, I'm very happy to hold it over time. So, yeah, I mean, that's a very simplistic way to think about it, but it works for me so far. And I think my way, the difficulty of portfolio management, I think, is if security analysis and actually understanding if you're good at it is difficult. I think like it's putting like difficulty on top of difficulty to actually figure out if you're a good portfolio manager. So for me, it's much more gradual process. That way has worked for some time. So I just track my actions and then adjust it over time. And having those 2 guardrails just protects me from disaster, but also protects my clients from buying like the mirror of an index.
No, I think I agree with you. It's more of an art than a science, and you have to figure out the balance that works for you. I manage money for families, multi-generational wealth, and I realized that proposing a 4-stock portfolio for them wouldn't work. They have to sleep well at night, so I have to find a balance. And for me, it's around 30 positions or so, and I'd like to hold stocks that I don't have to check on every 5 minutes. Any stock that would require too much of my attention shouldn't be in the portfolio. It's been a good filter for me. And I've held stocks in the past that I had to check on, if not every 5 minutes, then regularly. And I know it's sometimes just not worth it. I want to ask you the big picture question that's on a lot of people's minds, and I'll tell you how I go about it. But AI showed up in our industry, and a lot of our friends have different reactions to it. Some of us, reject it. Some of us embrace it. Some of us tell us about the limitations of it. But the truth is, I've been investing for 20 years, and 17 or so out of the 20, I have to say that the process for me was very much alike, not changing too much, marginal improvement. AI is disrupting something, and I'm curious, given your background, how you're embracing and looking at it.
I think it's interesting that they say it disrupts a lot. For me, it's much more, at the moment, it's, let's say, a little bit of an accelerator and getting like a first level understanding of a business. So, the way I use it, I think, is as good as many people use it, is if I find out a new name that is interesting or that appeals to me, like I use one of the like chatbot LLMs to basically play a question and answer on the industry and the business and getting like some like sort of information. But I think it may be a lot different for bigger companies, because what is attractive for the small ones is that there is not that much information out there. So even like an LLM doesn't have that good of a let's say foundation to figure out the company. So I think it's just an accelerator. And I'm talking about the investment space now, not in general. It's probably an accelerator getting from 0 to 1. But I'm not convinced at all that it helps or improves investors' understanding of the long-term value of a business. I'm not convinced at all. Maybe it helps you covering more names, but also like only from the 0 to 1, I think. So yeah, I mean, that's maybe I'm curious how you think about it, or where you think it's the biggest improvement to your process. And I mean, I would be curious about it.
I think I surprised myself how much I embraced it, and I'm operating in a different universe than you do, because I'm a US-based, US-centric, and I tend to invest in not the largest, I own the largest too, but larger companies in general that, at least in the US, have a lot of public information disclosed. Annual reports, earnings releases, transcripts, events in between, transcripts from events, and then a lot of news flow. So a lot of it is digitized, it's online. And I realized that then the amount of information that's being created, it's almost at the limit of my ability or anyone's ability to even just glance at it. So I'll mention here that I use Tenzing Memo, who actually sponsored this episode. And Tenzing Memo is a US-based company, an AI platform that takes all the public information and makes it digestible. But you know where the sources are. You can click through, you can look at things, and you can also add your own notes. And I think that's something people don't think about, but you write up something. I write up things all the time. And having a way to integrate it in my research, where I can take my own notes from a year ago and put them in some sort of a question answer model, where I can bring up something I haven't thought about in a while, really enriches my process. So I find this as a great way to get a head start. I think people might have the wrong idea that AI will tell you which stocks to buy. I don't think we're anywhere close to that. And if that really happens, it might not be for me, but I see it as a tool, as something that empowers certain investors today to do more with less, but also I kind of see it as zoom out to zoom in. When I want to look at 10 years worth of quarterly earnings or 10 years worth of annual reports, I want to zoom out, and then through some of those tools, including Tenzing, I can zoom in on a particular aspect that I feel that the management has been talking about in a slightly different way in the last few quarters. And then I can pull up the actual transcript. I sometimes get the audio, and I want to hear them say it. How did you guys actually mention it? So I think it allows me to do something that maybe a team of analysts would do for me, which I would say, can you go back and tell me what they are saying about stock-based compensation, right? And somebody goes in, spends a week, comes back to me and says, Q1, Q4, Q2, whichever one, they mentioned it. I go in and I can do a deep dive. So it does that for me. And I find it very helpful, because I think there are nuances that I might lose because there's an overwhelming amount of information. So I'll pause here, but that's how I see it. And I'll tell you more, but what are your thoughts?
No, I think that's where, let's say AI, it's generative AI. It's only a part of AI. I think shines is like when you have like text-based. We can also lump video and audio. The data structure is not entirely different, maybe to the surprise of many people. Like summarizing, or also like analyzing those kind of, let's call it, data structures. I think the biggest problem is, and I think that's where the biggest confusion is it is still, the way these algorithms work is like you get the average. They're trained to give you the average of what is out there, which is good if you want to have a summary, like you want to have the most important points, and these tend to be the most mentioned points. Yeah, the problem is usually when it gets more nuanced, and it's not really reliable because it will not give you the outlier by almost by definition of how they work. So I think having like a summary, like an overview, I think that's where the productivity boost comes from. And I think the one field where it really delivers a huge improvement is actually coding, because if you're like writing code is like it's natural language, like codified, so. And you have like a huge repository of code in like GitHub, GitLab, and Stack Overflow, which is like a Reddit for only coders. So you have a huge repository of problems and answers, and you have a text-based problem. And I think it should be to no one's surprise that it works. It's maybe a surprise how well it works, but that it works. Where it gets very, very dangerous if you broaden that out. So it's still the case that it's not very useful beyond text, and we can put image and video in it, because as it gets more powerful, the way you can, like a text is like a very long one-dimensional vector of words, which you can, I don't know how many words the English language has, like 50,000. I don't know, but it's like, and it's like you can put a 0 to whatever to it, and then you predict the next one. And if you think about an image, it's like, if you have like a color image, you have like the RGB values, and you can also like build like a long vector through it. And a video is a series of images. So you can apply the same. But if you're perfectly honest, besides code, I don't think that text, imagery, or video is a great data structure for analysis. It's not very precise. It's not objective at all. You can say it in one way or the other. So I think the way it breaks down is, if you want to, people think so much about productivity gains, for example, gains at the workplace, or think about automating processes. I think the analogy breaks down. AI is actually very good at it, but not, Gen AI, I wouldn't just, it's just not the right way to apply it. And I think the problem is bridging the gap. It's definitely not true that because they're good at like text, image, video, they will learn the thing. I think that's not true. And I'm almost afraid that because it's such a hype around it, all the other very interesting AI projects maybe don't get enough funding that you would actually need. So, it will be interesting to see. But coding is definitely one where I think it's a huge productivity gain. And it's very interesting because it's like the field that gets the most hype, and maybe you can talk about valuation in the investing world, is actually the one that is the biggest risk, because it basically like disrupts itself. And I think most of the other fields, like robotics make strong progress because, you can analyze visionary. I think they have to get let's say, like our fingers are very, very difficult to replicate, like the sensory around it. I think Elon Musk, I think he said it, like it's one of the most difficult problems to solve in robotics, is like actually like building fingers that work. But we have some progress there as well, because it's like you can see stuff. But if you think about analyzing like abstract data structures, it's not apparent to me why like Gen AI should be the right way to do it. If we get like solid progress on all these fronts, like that's probably where you get more excited, but I don't see it yet. And the second level is always, the tech is usually much faster than like us. So it usually takes much more time until the adoption kicks in. And so, that's my take on it. So, and that's basically what I'm watching for. So as an investor, I just it's very much more shy away from tech, because I think that's actually the one that is the easiest to disrupt, or is already disrupted. And everything that has to do with the real physical world, making like decisions that actually have hard consequences if you get them wrong, I think these are the ones. Or like if you actually build stuff in the real world, I think those are safe for a very long period of time.
Absolutely. And, we're excited about change, but when you're a business owner, you get excited about the lack of change. You want the same customers to show up for, your loaf of bread, and the loaf of bread as such has not really changed. We added different things to it and make it more exciting, but it's the same loaf of bread. I think for me, like the overarching couple of things, technology will come and go and it will change and evolve. And I think it's a fascinating time how many more tools there are. So I think that's great. And I think tools can empower investors. And I think we need more people to be participating in the market so that the price discovery works better. I don't think we can go 100% passive. I think it would be a sad realization, because if the stocks get bought only because they are a large holding in the index, nobody's questioning what these businesses are worth, right? So we need people. And the more tools there are, the more people feel empowered to question the prices that the market offers. So I think it's all good. We need more conscious participants in the market. But at the end of the day, and I think Ben Graham said it, and I forget the exact quote, but he said, at the end of the day, it's people. It's temperament, it's emotion, it's the emotional makeup, and it's the time horizon. So we might have a different tool, different technology. We even buy shares in a different way than our grandparents did, right? We're doing it, some of us. I actually never bought a share with a smartphone. I use my computer, my desktop to buy. But people buy shares with their smartphones. So that has changed, but businesses still need time to perform. We still need an emotional makeup to hold businesses. And if AI tools give you the courage, confidence to hold something longer, to do extra research and fact check something, more power to you, but it doesn't replace the actual conviction. I want to mention something. I was a junior analyst 20 years ago, and the way I learned investing, actually learned the craft, was doing almost manual labor, for lack of a better way to describe it. So I would listen and I would call in with a landline to an earnings call. I'm 45. I'm not 100. and I would take notes from the earnings call, and the transcripts maybe would come out, but a week later, we didn't have that, at least to my knowledge. So I would go for the earnings release. I would read the 10Q in the US. It's 10Q, and I would write up notes. I was doing the summary. And I would do it through our perspective of what we're looking for as value long-term investors. But a lot of that head work can be replaced by a tool these days, a head start. I'll still read it, but there's a head start here. So I think it saves some time. And I think it leaves more time. Time is very precious, only 168 hours in a week. You have to sleep some of the time. You were holding 2 jobs. I don't know how you did that. But we need to sleep at some point, right? So if you can have tools that save you some time to actually think, I'm all for it. I'll mention something else that I find fascinating about the whole AI transformation. To me, it feels different than the internet and the other disruptions that I witnessed in my lifetime. We are expected to have those huge investments, right? So it's not $100,000 startup in a garage. We're talking about hundreds of billions. The economics, at least of the business models that are appearing now, are not so clear to me if they compare even with the software models that we had. And at the same time, on the more exciting side, is what I see is that people have integrated some sort of an AI tool in their life, in their personal life, in their business life, so quickly. And it's amazing. There's not a conversation, even a casual conversation among friends, where they don't tell me that they looked up something using one of those AI tools about a mundane, everyday thing. How long does it take to cook a hard-boiled egg? And I thought, wow, so instead of calling your grandma, you ask one of those tools and they tell you, it's that many minutes and so on. There are a lot of things that are different about this revolution, however you want to call it. And I love watching it. I don't have the answer.
No, I agree. Personally, I think as you said, it's the way AI works, or the economics of it, is not comparable to SaaS. And I've written about it in our recent letter. I think it's much more capital intensive, and these companies basically changing their business models to a much more, capital intensive, probably, therefore maybe worse business model than they historically had. And they're trading at the highest multiple with the highest expectations at that. Probably maybe the riskiest inflection point in their business history. Maybe put Microsoft aside, they had a couple of those, but I guess all the others it's probably the riskiest inflection in their business. And I think that's just yeah. I mean, every investor has to decide him or herself if that's the right risk to take. It's not for me. Yeah, but I'm a personal user of AI. And I'm very excited to watch it. I mean, for now from the sidelines as an investor, but yeah, I mean, it probably will prove out to be like one of the great inventions. But I mean, that doesn't mean that it's a profitable way to invest in it.
That's the challenge with things that change our life. They are not necessarily immediately a good business or investment opportunity. And I want to emphasize something that I've been thinking about lately a lot more, how the initial phase of what we think we're going to experience might not be the final outcome. So the internet of the 1990s, nothing like the internet we use now in terms of ease and use and speed and the fact that you have internet on a little device in your hand, and that the business models that it created, there was no way you could have imagined it. Like, I don't know. I have, just a sci-fi kind of experience when you really think about it, right? That you can send photos and you can have a video call with somebody from the palm of your hand sitting on the beach. I mean, to you and I, it seems obvious, but 10, 20 years ago, it was unheard of. So the things we could do with AI, I think we have to really expand our imagination, what it can do. And I'm sure it's going to be reinvented and changed again and again. But what we've seen so far, it's touching a lot of aspects of our life, and I think including our industry as well in some way too. David, I want to ask you, you have one role now, you have more time back to just focus on investing, but tell me about this life and work balance and what fulfillment means to you and what wealth means to you. What are the important lessons you've learned combining the passion that you have for investing, family life, and everything else that's important to you? How do you make it all work?
I'm afraid I don't have a good answer to that. So I'm learning in real time as we go. So take everything that I say with a grain of salt. But I mean, my realization, and I mean also that of my wife, was, I mean, and that's also why, by the way, why I switched jobs, was that we value freedom more than we value money, which may sound weird for an investor because in the end it's all about money, right? But I can say that many people say they would invest even if they wouldn't get paid for it. But I mean,
Yes.
That's actually how I started. Like, I really didn't get paid. So now I get paid a little, but still very little. So yeah, it's being an entrepreneur is an adventure, and I think it's a better model for us. I mean, how we married with the family, it's much more, you have to time box. I mean, you can even get rid of sleep if you want to research more stocks. I think there is no end to it. So at some point you have to decide for yourself, like, how many more hours you put in. So I think that's what I, to be perfectly honest, struggle a lot, like actually like finding an end. But yeah, that's what I'm continuing to working on, like finding the right, balance. I mean, what definitely helps is being an entrepreneur gives you more flexibility with your time. And as a value investor, usually you don't have to work on something in this moment. So usually there is like, you have time for it, you have to do it, but there is not like, it hasn't to be done by now or like tomorrow. So you have the flexibility if to take a couple hours off. I mean, I try to get up very early. I mean, now we have 2 kids, so everything's now flipped on its head again. But I try to get up very early, get some work done. Therefore, in the afternoon, taking maybe 1 or 2 hours off in the afternoon to play with my son. Then you can catch up later in the evening. So I think that is actually a very good model to do it. So yeah, but I don't have the answer. But I think it's what Bezos said. There is no work-life balance. It's more work-life harmony. So I'm continuing to work on that harmony. So, but it's a big challenge. But maybe one point that maybe is actually worth sharing, and I think maybe that's interesting to the audience, is I think especially let's call them in our bubble of, let's say, very ambition professionals, like people who are ambitious with their careers. I think there is a trend to, for some reason, is like being successful with your career and then basically starting a family or having a partnership. So it's almost like the jewel, like the crown jewel, like, yeah, that's the award. And I think that's the completely wrong way to think about family and partnership. So I think what has been true for us since we have probably families, and if you talk to your parents or like your grandparents, is you actually have like a partnership and a family was one of the first things that you started when you were an adult. And
Yes.
over time, you struggled through life together. And I think that is what builds like the strong bond in any partnership in the family. And I
Yes.
mean, it's incredibly hard to have like two small kids and like struggling with the career and the business. But it is actually true. I mean, the bond that I have with my wife, I mean, we've been together for a decade now, or over a decade now. And I'm only 29, so that's a long period
Good
of time.
for you.
But yeah,
Congratulations.
yeah, thank you. But I mean, that bond of now going through the business together and having the family, I mean, that is something that you cannot have when you don't go through it together. And I think it's the same thing with the family. And that's probably a contrarian take, because I don't think there are that many young parents in our space. But I think that's probably the true wealth in life for me, is like basically going through life together with your partner and family and creating that bond over a lifetime. And if that's everything that I had, then I would be happy. For now, I also have to put food on the table, so I try to put up good returns, and I love doing it. But probably the combination of those is what makes it work for me.
It's for lack of a better way to describe it, it has to be balanced. It's one at the expense of the other sometimes, but I think you can be better at investing if you're happy at home. And you can be happier at home if you're doing well with the pursuit that's taking up your attention and you love. And the money aspect, and I dance around this idea that when you really, really think and look at it closely, and it's a funny thing to say on this show especially, but it's not about the money.
Yeah.
When you really think about it. I know we have to pay bills. I know there are some demands, but I met people that spent half a century picking stocks, and they have not done it because of the money. They've been comfortable for long enough to go fishing and do something else, yet the pursuit itself draws them in, and they want to do it again and again, and hopefully do it in a way that doesn't disturb the family and the relationships in life and the love that you can have. But there's a thought there that you like it so much, and you are doing it when you are not paid, and you'll keep on doing when getting paid will not matter to you. That's what I'm thinking.
Yeah. No, I think that's true. And I think a funny story is, I think it was Matt Damon. I think he won the Oscar with Good Will Hunting at a very early age. And I think
Yes.
a year after that, he was in an interview, and he basically, like, they asked him how he's feeling. And he says, like, he's so lucky that he won it that early, because he was, I think the day after, like, he was so scared, because he said now he has achieved it, and he said it doesn't mean anything.
Right.
So now other people
Yes.
chased that trophy like for like their entire life. And if he would have figured that out like when he was 80, like it would be like a miserable life to live. And I think it's the same thing with money and investing, because that's what we're here to do, like as an investor, make money. But I think it's the same thing. If you do it for the money, I mean, it's always nice to have more money, but you should find a different meaning to it than just the financial reward.
I think Charlie Munger had this saying that I included in one of my books, that it would be not enough of a life if it was all about buying securities, putting them in a vault and waiting for them to appreciate. And however he said it, I thought it's so powerful. Yes, we're trying to do that, but there's so much more to life.
No, it is. It is.
We're going to leave it at that. David, this was so fun. Thank you so much for sharing your thoughts and your perspective on investing, the kind of investing you do, AI disrupting or not this world that we live in, and all the exciting things that are happening in your life. So I recommend everybody to explore the episode before that you were on, and all the work you're doing and sharing on Substack and all the writing you're doing. So thank you so much for today. I really appreciate it.
Thank you so much, Bogo. It was a very fun conversation. Like, again, as I didn't expect anything else but very thoughtful questions, and I hope the audience like enjoys the show and gets something out of it, some value out of listening to what we're talking about. So yeah, and I'm already looking forward to the next one, whenever that may be.
We'll do it. Thank you so much.
Thank you.
Before we wrap up, a quick reminder: if you want to supercharge your investment research like I have, check out Tenzing Memo. Don't forget to use code BILLIONS at sign up for your extended trial and 10% discount. It's been a game changer for my process, and I think you'll find the same. Thanks for listening to Talking Billions, and I'll see you next time. You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.